Let's continue with the rest of the bull put spread option strategy. In part 1 of the strategy video, we have went through what a bull put spread is and also when is the best time to utilize this strategy. We have also talked about how to determine the duration of the trade, as well as the selection of the short and the long strike. Finally, we went through the risk management portion of the bull put spread strategy. If you're unfamiliar with any of these concepts, do watch part 1 again. Link to that video is in the description below. For the rest of this strategy, we will be discussing the trade management and repair, optimizing techniques, as well as a wrap up comparing the bull put and the bull call option strategy. So let us start off first with the trade management. The rules here will serve as a guide on when to take profit, when to take loss, as well as how to repair a trade that has gone wrong. We will be sticking to the same example from part 1, where we have executed a bull put spread on the SPY with an expiry of 16 October on the 315 strike, and then we have bought a reinsurance on the 16 October, same expiry, 314 strike. So when is a good time to take profit? Naturally, you can wait for the entire trade to expire worthless and then realize the collected premium in full as the profit. But what if SPY skyrockets way before the expiration date? Let's say it's only the 1st of October and SPY has reached an all-time high of 360 and the value of our trade is almost close to zero. When this kind of scenario happens, I would consider to close the trade early and realize my profits. The general rule of thumb will be this. When 90% of the max profit is achieved, it is generally worth it to exit early and remove all the risk off the table. This is especially when there is still a lot of time left on the trade. Like in this case, between 16 and the 1st, there is still more than 2 weeks away. And the value of our trade is almost close to zero. When this kind of scenario happens, I would consider to close the trade early and realize my profits. And because there's still a lot of time left, SPY could potentially plummet back down to below 315. And when that happens, all your unrealized profit will be gone. And worse, you are left with a losing trade. Alright, so consider to take profit early when 90% of the max profit has been reached. So what about taking a loss? This is straightforward. We will just exit when the max loss per trade is reached. In this case, our example will be $100 per trade, and we are not risking more than 1% per trade. But what if you do not want to take a loss? Now, this is the part where you have to listen carefully because the next trick on how to repair your trade will be what you need. Basically, when we repair our trade, we want to prevent the stock price from hitting our short strike, which is at 315. So what we have to do is to buy back our short put and then sell a further out of the money put to maintain the delta. Now imagine this scenario, which is the trade example that we have had. Price is at 334 when we have entered. Immediately after we entered, price broke the 50 moving average and dropped to, let's say, a low of 325. Now at this point, what we want to do is to buy back our bull put spread and then sell another bull put spread with a lower strike. And when exactly should we do that? Also, what should we look out for? Here is the specifics. You will want to monitor the trade daily. And when price falls, the delta of your short put will increase, am I right? When the delta of your short put increases by 0.1 to 0.15, this is a signal that you will have to repair the trade soon, or your max loss will be threatened. Initially, we have said to sell the put with a delta of 0.25. So when the delta increases by 0.1 to 0.15, your short put will now have a delta of about 0.35 to 0.4. So if the delta increases further beyond 0.4, it will generally be not worth it to repair the trade anymore. And to repair the trade, what you do, once again, is to buy back your bull put spread. You will have to close your short put by buying back the put at 315, which you have sold previously. And then you sell away the put at 314, which you have bought previously. So this action will neutralize the initial bull put spread that we have owned. And after that, what you want to do will be to sell another bull put spread with a lower strike price. And this time, we'll still be targeting the ones with 0.2 to 0.25 delta again as usual. So let's take, for example, we now sell the 305 put, which has a delta of 0.2 to 0.25. And then we buy back the 304 put to create this bull put spread. And then the next question is, which expiry date should we pick? Now, if your original spread, the 315 and 314, still has more than or around 30 days to expiration, you can select the same expiry for your 304 and 305 bull put spread. However, if your original bull put spread has less than 30 days to expiry, in other words, there's not much time left, then sell your new bull put spread further out in time. You can select the option with 30 days or more expiry. So in summary, when you repair a trade, this is your general course of action. For information so that you won't be lost when you hear these terms in the future, Action 1 and Action 2, when they combine together, is also known as rolling your trade or rolling your option. In this case, we are rolling the option down. Down because the strike price went down from 315 and 314 to now 305 and 304. And it is important to note that the expiry of the option remains the same at 16 October. Now, when we roll the option out, this time it means that we are selecting another option with a longer expiry. For example, the 1st of November instead of the 16th of October. Next, you also commonly realize that when you roll or repair a trade, your overall profit gets reduced. For example, when we sold this bull put spread, we have collected a premium of 19 cents. When the delta increases and we buy it back, it is often with a small loss. Let's say when we buy it back at 30 cents. And then we will sell another one further down at, let's say, 20 cents. Just for example. Now, do you realize that your max profit from the trade has fell from originally 19 cents per contract till now only 9 cents per contract? So by repairing the trade, your max potential profit has reduced. So then, should you still repair your bull put spread? You might be in favor of this management style, and I would say that it's generally okay if we are rolling down within the same expiration and still get away with some amount of profits. In this case, we still have 9 cents of profits per contract. But oftentimes, this is not the case. You will find that there's simply not enough time premium left in the option for you to profit off within the same expiry. In this case, you have to roll out and down from 16 October expiry till now 16 November expiry. Another month out and more time for stock prices to move. So therefore, rolling out blindly is not always a good idea. For some visual illustration, let's look at the price chart. Let's say that at the end of the chart over here is the 16th of October, which is your initial expiry. Prices only have this little time left to drop sharply to hit your short strike again if we repair our bull put spread to the 305 and 304 strikes. Now in this scenario, it makes rolling favorable if you can still collect a minimum amount of profit. However, if we will have to roll onto the November expiration, the chart becomes something like this. Now your trade expires here, 16th of November, and you can see that there's so much more time left for the stock price to gradually move slowly down and down and down and hit your repaired trade again. And furthermore, when stock prices break through the 50 moving average, it has already broke the key support that leads you to place your first trade. And now with no suitable support within range, are you really comfortable with rolling the trade out now? Right, prices can easily continue to fall down to the next support, which could be the 200 moving average, for example. And this once again will be too close to your repaired bull put spread at 305, and then you might face a loss again. So therefore, even though I've covered the technique of repairing your bull put spread, personally I do not really favor the idea of repairing a trade. I feel that it sometimes gives the illusion or false hope of staying in a losing trade for too long, just to lose more. And this habit could easily become a slippery slope towards a bad outcome for your portfolio. So therefore, what I will do is to view this as a closure to the first trade. Accept whatever profit or loss it may give, reanalyze the chart again for potential supports before opening a new trade. And I'll keep these two trades separate instead of lumping them together. And I'll also accept and prepare for another set of full losses if the new trade does not work out. Alright, so enough about repairing and rolling. Next, let's talk about when is the best time to trade using bull put spread. As you should be familiar with the strategy, a bull put is a net selling strategy. You profit from the premium collected. So naturally, you want the option to be as expensive and premium rich as possible so that you can collect lots of money, am I right? Option premium is usually high and expensive when the volatility is high. One way you can tell this is by looking at the VIX. The VIX gives you the overall volatility of the broad market. The higher the VIX, the more volatile it is in the broad market out there. However, one con about the VIX is that it is very relative to the time frame that we are referring to. This is the chart for VIX, and you can just search up the ticker VIX to assess the daily price movement of VIX. Right, so for example, in 2019, which is this period over here, we can see that when the VIX has a value of around 10 to 12, it is generally considered low. And when VIX shot up to a value of about 20, it is considered high, and in fact very high. But coming into 2020, as COVID struck and all the uncertainty came, now a VIX of 20 is considered extremely low. You can see that in fact a VIX of 20 has become the support. Alright, so during this time frame, as we move into 2020, we will consider a VIX to be high when it is at around a value of 30 to 40. So it is very relative, and you have to be aware of its historical price action before you can determine using VIX whether the volatility now is high or low. So another more useful parameter that I rely on is the IV percentile of the stock. IV here stands for implied volatility. For volatility to be high, we want to see the current IV percentile to be in the high 30s and ideally above 40. This is the best time to be selling bull put spreads. For more in-depth explanation on implied volatility, check out my video on the option Greeks, links in the description below. So going back to our trade example, at the low IV, you would have collected 19 or 20 cents for this trade, about 20% in terms of the differences in the strike prices. Now, when we have a high IV, you could expect maybe about 25 cents or 30 cents to come from selling the same bull put spread. Right, generally about 25% of the premium collected in terms of the difference in strike prices. Of course, different stock will behave differently in accordance to high or low IV. So pay attention to this and get a feel of how volatility affects option pricing the next time you trade a strategy. And lastly, on to our very important optimization, we will be looking at the win rate and profitability of the strategy. Now, to calculate the win rate, you can use the delta of a short put as a rough gauge. The delta tells us the probability of the option going into the money at expiration. So when we first traded the 0.25 delta short put at 315 strike, what this means is that there is a 25% chance of this short put getting into the money. In other words, SPY falling to 315 or below. When that happens, we will lose the trade. So with that, let's do a simple calculation using probability. If we trade just one contract per trade and stick to our risk management rule, meaning you say that we do not risk more than $100 per trade, and this $100 represents 1% of our max capital, and let's assume that max profit is now $20 instead of $19 in our previous cases, right? And that will lead us to having a max loss of $80 on this trade. So assume that each trade is done at almost similar conditions, and after 100 trades, with a win rate of 75% and a losing rate of 25% as derived from the delta, this will give us 75 winning trades and 25 losing trades. The winners will bring in a total of 75 multiplied by $20 per trade, giving us $1,500 in profit. But our losers, on the other hand, would have lost us $2,000. Now this translates to a net loss of $500. So what I have just described falls under the conservative and safe way of trading that we have went through in step 3 in part 1 of this strategy. Alright, so if you recall, the max loss for the bull put spread, we do not allow it to exceed our max loss that we allow per trade. So this means that we will not come out profitable if we trade this strategy the safe way, and we have to take on more risk to make this work. Alright, so if we move on to adopt moderate risk, this will allow us to take up 2 contracts per trade. When you trade 2 contracts, your max profit will be $40 and your max loss will be $160. But because we exit at 50% of max loss, therefore our potential max loss will still be capped at $80. This will mean that you have to cut loss early when your bull put spread has reached a loss of $80. Alright, so with this method of risk management, a rough calculation will give us these results. Our 75 winners will now give us a profit of $3,000, and our losses will accumulate to the same at $2,000. And this will give us a net profit of $1,000. Alright, so you get the idea. And if we adopt an even more aggressive and high risk approach, where we will cut loss when 20% of the max loss in our option trade has been reached, this allows us to take up 6 contracts per trade using this example. Alright, so with 6 contracts, your total max loss will be 480, and your max profit will be 6 times 20, which is 120, right? And then since we'll exit when 20% of this max loss has been reached, this means that we essentially cut loss at $96, right? And this $96 is still less than the 1% of our max capital. Alright, so it still obeys our risk management rule. If we trade under this style of management, our winners will bring in $9,000 in profit, 75 multiplied by 40, and our losers will cost us 25 multiplied by $96 per loss, and that will cost us 2,400. And net we'll still have a profit of 6,600 after 100 trades. Alright, and of course, the higher risk you go, the more discipline you will need to follow risk management rules strictly and do not get into trouble. Because if you do not cut loss immediately at $96, what you might be facing would be the $480 max loss from 6 contracts. And that $480 will be a heavy 5% of your max capital. Alright, so just imagine 5% of your account gone in a trade. And how many trades do you need to make back that 5%? So risk management rule will be very important, and you have to obey your predetermined stop losses very closely. Alright, so with that, this is a summary of the bull call and the bull put strategy. Both of these are bullish strategy that you can use when you are bullish on a stock. However, each of these strategy behaves very differently. For both of these strategy, we want the price to be near or bouncing off a support. However, for the bull call spread, it is a debit trade, meaning you have to pay a premium to take up this trade. So therefore, you would like this to be done in an environment of low implied volatility. And the ways to profit off the bull call spread will be when price trades above your break even by expiration. Even though this has a lower probability of winning, your reward to risk ratio is generally high, meaning to say when you win more than you lose. On the other hand, bull put is slightly opposite. You collect a credit or premium when you place the trade, and therefore you like to do this in an environment of high IV. When you do a bull put spread, you can be neutral on the price movement of the trade. Meaning to say, even though price trades sideways, do not move up, you will still be profitable. Alright, and since you have two ways of making profit, either price stays sideways or move up higher, and in some cases you can also find yourself profitable, even though your price trades lower, but as long as it stays slightly above your short strike. Right, so with so many ways of being profitable, you can expect there is a high probability of profitability in the bull put spread. Furthermore, you can adjust your short strike at which you sell to manipulate your winning probability. If you sell a short strike of 0.1 delta, you have a 90% probability in winning the trade. And of course, with such a high chance of winning, as such, your reward to risk ratio is low. You generally lose much more than when you win. And therefore, when you trade the bull put spread, your risk management strategy and style becomes very important, and your trading discipline will come heavily into play as well. With that, I hope you have enjoyed and benefited from these tutorials. Most important of all, stay safe and disciplined in all your trades and reap the rewards you deserve. Join us in our Telegram community group using this link for more discussions and sharing of ideas. Show your support by leaving a like and subscribe to the channel. Turn on the bell notifications to receive first-hand updates on new content. Thank you so much for watching, and I'll see you in the next video.